So a crypto stop loss strategy. We all know that to be successful as a trader, that you need a system that you trade, and you need to stick to it fairly robotically. And the determination of where to use your stop loss and how to do good risk management is one of the key principles of that system. And a lot of you have been asking Nicola and I questions about this, and I was thinking about the other day, how do I actually explain this to people so they understand how to do it effectively? And I realized I actually use a little spreadsheet to help me calculate stuff. So I created a little bit more detailed spreadsheet for you guys so that you can use it to do your own calculations. You can create your own strategy using it. I'm going to suggest don't use my strategy, try out your own. But you can use this strategy as a starting point for how you consider how to do good risk management with figuring out where to put your stop losses. And before we get started, I would really appreciate it if you would take a few seconds, scroll down, give us a blue thumbs up, hit the subscribe button, click the notification bell, and select all. That really supports the channel. We are really grateful for all your support. All proceeds from using our affiliate links or any donations made to this channel we use to create infrastructure projects here in the conscious community we're building in Costa Rica. So I know it doesn't sound sexy to talk about paving a road or building a water catchment project, but the construction of those projects not only provide jobs, but the ability to bring more tourists into a region actually is huge for the economy in Central American countries. So we deeply appreciate all your support. If you find value in this video, feel free to give us the equivalent of buying us lunch or coffee and make a small donation to support our projects. So let's get started. So you will see in the description box a link to a document called Leverage Risk and Stop Loss Calculator. What you do is you make a copy of that document to your Google Drive, and then you can actually start changing the numbers and edit the document to create your own strategy based on the principles I'm about to explain. The first tab in this document basically gives you the list of the steps you go through to create a good risk management strategy using stop losses. So the first thing you want to do is determine where you need to place your stop loss. There's several options to this. Nicola and I have done a different video on this, showing many of the options for figuring out where you want to put your stop loss. I've listed my favorites here. So option A is you use the other side of the Ichimoku cloud, plus you probably add a few extra pips. You can use the other side of the pattern you're trading. So if the pattern breaks up, your stop loss would go below the pattern. You can also put your stop loss across the EMA ribbon. You can also look at the VPVR indicator, the volume profile visible range indicator, for confirmation of where the rest of the market is placing all of their orders and stop losses. That can act as a confirmation of whether or not whichever strategy you chose here is actually a valid strategy. So I'm not going to go into these in detail on this video. We have a different video on that, which will include the link to that video also down below. Okay, so the second thing you're going to do is you're going to adjust the numbers in the spreadsheet. I'm going to show you in a minute. You're going to make sure your correct portfolio size and the current market price of Bitcoin or whatever cryptocurrency you're trading or using this field to calculate is correctly placed. And then number 3, based on where you determined that you needed your stop loss up here, you're going to determine the appropriate level of leverage in order to choose your risk. Okay, so there's the steps here. Now I'm going to explain each of those steps in a little bit more detail. So you'll notice here the next 2 tabs are a long calculator and a short calculator. Okay, the short calculator is exactly the same as the long calculator. I've color-coded it red because we normally associate reds with shorts and longs with greens. So the math is just in the opposite direction on the short calculator. So I'm just going to do the long calculator explanation on this video. Just know if you're placing a short, everything's in the reverse direction. So the first thing we want to determine is what's the size of your account. So you're going to fill that in for your account once you've copied the spreadsheet. So I'm just using $10,000 because it's a nice round number. It makes it really easy to understand these calculations. Okay, but if your portfolio is 7,000 or 50,000, you're going to put the correct number in here. Then you're also going to fill in whatever the current market price is for Bitcoin, or if you're using this to calculate on a different cryptocurrency, the current market price of that cryptocurrency. Now you'll see this first set of numbers here are for if you're risking 2.5% of the amount of money you have in your trade account. And this second set of numbers here is if you're risking 5% of the amount of money you have in that trade account. So you'll see this 250 is 2.5% of 10,000. 500 is 5% of 10,000. Most traders recommend that you do not go above 2.5% on the average trader. Some do 5%. Super experienced traders sometimes go as high as 10% or even slightly higher if they're super confident in the trade that they're making. But normally with good risk management, you only want to risk a very small amount of your portfolio at any one time because that keeps your emotions in check. If you're risking too much at any one time and you start losing big quantities, then you're going to start making really stupid decisions. You'll find over the course of doing numerous trades over weeks and months, this small amount will still lead up to very big returns. If you start risking more than that, then you're actually risking your mindset. And if you don't have an effective mindset as a trader, which starts with having a really solid system where you always make your decisions in the same way, doesn't have to be the same system everyone else uses, but you want to always make your decisions consistently, because that way it limits the risk. If you're always changing your strategy, if you're always changing the percentage you use, if you're always changing how you do your stop losses, you're significantly increasing the risk to yourself, because then you're no longer using the law of averages. So you want to use solid strategy, but a good trader is probably winning 2 out of every 3 trades. That's why you tend to do trades where there's at least a 2-to-1 risk-reward ratio, because if the risk-reward ratio is higher, then on the winning trades, you'll be making a lot more money than you ever lose on the losing trades, because the most you would ever lose on a losing trade is this 2.5%. Or if you're risking 5%, then you might lose the 5%. Personally, I like the 2.5% rule. It keeps my mindset nice and relaxed. Then I don't worry too much when I lose a single trade. So let's say the market price of Bitcoin is at $50,000. At a 2x leverage, that means that the price of Bitcoin can retrace 50% of this amount before you would hit the liquidation level. At a 3x leverage, the market can retrace 33.3% before you would ever liquidate. At 5x, it can retrace 20%. At 10x, it can retrace 10%, etc. If you were risking the entire amount of your margin, then your liquidation price would be this low. Okay, so the formulas for these are automatically filled in for you, right? So this is the first style of using a stop loss. In other words, you put in a trade. If your margin's $250, then that means at a 2x leverage, your trade size would be $500. And in this case, you would be putting your stop loss just above the liquidation price. In other words, you're risking 100% of your margin, but it allows you to do the math fairly quickly then, and you understand how much risk you're taking. I've marked these particular leverages in red because I don't recommend you ever use these. You have to be a really experienced trader to go above these levels. And even then, really experienced traders lose a lot of money trading at higher leverage levels. That's because the amount of market retracement you can have at these higher levels is very, very little. In other words, if you're doing a 100x trade, the market can only retrace 1%. So if the price of Bitcoin is $50,000, the market can only retrace $500 before your trade is liquidated. So normally experienced traders don't use these levels of leverage unless they have an already open trade that the price has moved significantly from their entry point, and then they're adding to that trade and increasing the leverage. So we've talked about that strategy on other videos. I don't recommend you use that strategy unless you're an already experienced trader. So if you're a newer trader and you're just figuring out how to do this, I recommend you stay out of the red zones I have on this chart. So basically, here's the chart if you're using 2.5% risk on each trade, and this is the chart if you're using 5% risk on each trade. And by that, I mean you're risking 5% of the money in your trading account at one time. Now, hopefully, you've got other savings and other places that you hodl cryptocurrency. And by that, I mean hold on for dear life. That's a common acronym we use in the trading world. And you have other investments. You never want to put all your eggs in one basket. Trading is a high risk form of investing, especially when you don't know what you're doing yet. So I do recommend that you start with a small amount of money in your trading account until you're really well seasoned, and then you start increasing that amount. So start with a small amount of money and start with a small percentage of your account initially. In fact, even very seasoned traders still only do the 2.5% level in terms of determining this, okay? So the other thing I want to show you is, so this first set of column is you're basically using the liquidation price to choose where your stop loss goes to keep your risk at 2.5% of the amount of money in your account, okay? Now this set of columns are, what if you wanted to use a 50% stop loss? So in that case, if you were using a 50% stop loss, then the margin on each of your trades, in order to risk the same 2.5%, would double in size, right? Because in other words, here you're using $250 in margin and you're risking the entire amount. Here you're using $500 in margin, but you're only risking half of it because you're putting your stop loss at the 50% level. So same set of calculations here, except that now, because your margin is a little bit bigger, your trade size is a little bit bigger. However, here's the principle I want you to really understand, okay? If you look at this trade here, so risking at the $250 level, a 10x leverage trade amounts to $250 trade, okay? And that's where your stop loss is placed, just above the liquidation price. This is actually that same trade, okay? So using a $500 margin, risking half of it, so you're still risking the same $250, you've just entered the trade differently in this case, okay? Now your margin is $500, you're only using a 5x leverage, so half the leverage, notice that. It's still a $2,500 trade, and it's still the identical level of risk. Now, the interesting thing about these two trades, the reason I bolded them is I wanted you to see these are essentially the same two trades. So what are the pros and cons to whether or not you use this strategy where your stop loss goes right above the liquidation price versus this strategy where you're using, let's say, a 50% stop loss? And you could easily create a whole nother set of columns where you do a 75% stop loss or whatever, or a 25% stop loss. So this is where you can play around with these charts and figure this out. But the main point that I want you to get here is this trade with this level of risk is exactly the same as this trade with this level of risk, except in this case, your fees were lower because you used more margin and borrowed less money. In other words, you actually, at the lower leverage rate, end up paying less to do this trade. That's why a lot of us have this paradigm that going to high leverage is way better because you can make bigger trades, but at the same risk level, it's actually better to stay at the lower leverage, use more margin, and use a higher stop loss to create the same level of risk. And in that way, you're actually paying way less fees to do the same level of profitability in your trading. I hope you understood that the way I explained it. If you have questions, please post them in the comments section below. I can always do a follow-up video to this one to help explain that better. So why do some experienced traders choose to use stop loss just above the liquidation price then? What I'm going to suggest is the only time you might want to do this is if you really feel like you have to get into a trade quickly. And I really want you to check your emotions in this case because FOMO has you lose money. Fear of missing out has you lose a lot of money as a trader. So if you really feel like you've got a rush to get into a trade, you really want to do a gut check. Is this actually a solid trade to get into? Because if you're rushing, you usually make a lot of mistakes. But this is a faster method in terms of doing the math, because you're essentially opening up your trading platform and you can actually just do your calculations really quickly in your head because you're just basing it on the liquidation price, right? So it's a quick percentage run. Whereas here you've got to figure out, oh, if I have to divide that in half, it takes a little bit more to do the math to figure out this trade. That having said, if you use this chart to guide your trades, and if you did that for the next 20 or 30 trades, you would get a sufficient feel for this that you would be able to call the leverage just by understanding how to do the math in your head because you've done it so many times on the chart. Basically, the way this works is if you change, let's say you have $12,000 in your portfolio. Now you'll notice these numbers automatically updated, the size of the trade automatically updated, right? And again, this column here automatically updated here as well. So I just want you to notice this automatically calculates based on that. And again, if you change the price of Bitcoin, actually we're in a bit of a slump right now. So let's say we lowered the price. Again, it would give you the correct calculations for how you're doing this trade. So I hope that helps. Please post your comments in the comments section below. And there's lots of ways to do this. This is just one system, so you may learn other systems elsewhere. I encourage you to try out different systems, but don't be changing systems all the time because it's the changing all the time that increases your risk. But please leave your comments and questions below. We can always do update videos on this. I'll also refer back to this video in other videos that relate to this concept of risk management and figuring out where to put your stop loss. So that will help you understand how to integrate this into a successful trading strategy. So thanks for watching. Don't forget to give us a thumbs up on the like button, hit the subscribe button, click the notification bell, and select all. We do technical analysis. We also talk about different scenarios that might affect the price action in cryptocurrency, especially focusing on Bitcoin. And we also focus a lot on mindset on this channel. On Conscious Crypto Traders, we believe 80% of what it takes to be a successful trader is mindset and understanding trading psychology. So we want you to win by understanding how to manage your own emotions, how to trade more consciously. If you found value in this video and the tools that we're offering, feel free to make a small donation to help us with our infrastructure projects here in our conscious community in Costa Rica. If you'd like to know more about Vista Mundo, we will leave a link so you can have a look at our community down here and get a feel for it. We are one of the few land developments in the world where you can buy land with Bitcoin. Our community is situated under a beautiful food forest that we are in the process of creating, and some of your neighbors would be fellow traders. So stay tuned to Conscious Crypto, and until we speak next time, trade consciously.